G'day there, Investorholics. Today I thought I'd take a little bit deeper dive into the oil situation and think about where we might be able to make some profits in the rising market. Where to invest. There's a few different ideas that I'm going to give you along the way. We'll have a look at a little bit of history, what's happening and where the whole thing may go. Stick around, guys. I think this is a definitely educational one and might help you start some of your own research into some opportunities in the oil space. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. Okay, let's jump into it with a few headlines. So agreement between OPEC to cut 9.7 million barrels a day to the end of June. That looks like it's going to happen. There was a bit of uncertainty whether everyone would play ball. So the reduction should stem the flow of crude against the backdrop of declining demand amid the coronavirus lockdowns. Starting to see a few of these lockdowns lifted, so that might also help the supply demand side of things as well. So US production has also fallen, so that's definitely a tick for the oil price. So the Energy Information Administration forecasts declines in US oil production of 197,000 barrels a day to 7.8 million barrels in June. So that's also a good tick, and you should see some lift in price from those moves anyway. So just give a recap for those who have missed out or don't actually know all the critical pieces of information. So 21st of April, following the largest one-day sell-off ever, US oil futures prices were negative for the first time in history. So West Texas crude oil futures fell almost $56 or 310%. to minus $37.36 a barrel. That's brutal. The largest price drop in history, apparently. The first time the commodity has traded below zero. Okay, let's have a look at it all unfolded. The lead up. So an oil price war was fought between, or is still being fought between, OPEC and the non-OPEC producers. Coronavirus pandemic caused an historic oil supply glut. Land-based storage facilities are effectively still at capacity or pretty close to capacity. Oil is now being stored offshore in oil tankers at sea. So we saw the ETF traders desperately trying to offload contracts before settlement to avoid taking physical delivery of the oil. The high cost of capping wells meant that many producers were paying someone else to dispose of their oil. The circumstances were unusual and unprecedented, but oil is the most efficient rebounding commodity given natural decline curves and finite reserves. The United States Oil Fund, LP, which has the code of USO, is the largest crude oil ETF by assets and volume. So USO was thought to have held approximately 25% of the outstanding May expiring contracts. USO has no storage facilities and has no interest in taking delivery of the oil. Holders of the USO ETF needed to rid themselves of their obligation to take a physical delivery of the oil. USO paid buyers to take delivery of the oil, which caused a negative oil futures price. So let's have a look at the aftermath of the whole affair. Extended record low prices will impact marginal oil producers with high cost bases. Oversupply threatens hundreds of US shale oil producers with the prospect of Chapter 11 bankruptcy. The Russian oversupply tactic may put the US energy independence in jeopardy. Conspiracy theory is that this is actually what they're trying to do. They're trying to bankrupt a heap of suppliers, producers in the US to actually get some leverage over the Americans anyway. But you know, who knows if that's really what the state of play is. But it wouldn't surprise me if that is what the whole thing is about. So no doubt we're all wondering where the opportunities to make some money are. So let's have a quick look. We'll have a look at the majors. We'll have a look at what options are there in the Aussie oil space. Look at the ETF plays and also oil storage. So there could be some interesting options there. So let's have a quick look at these ones. So let's have a look at the majors. So your first stop might be a listed international company or oil producer, such as ExxonMobil. So according to analysts, ExxonMobil's New Mexico properties are profitable at approximately $27 a barrel. Exxon can leverage its scale and diversified resources to turn a profit at much lower costs. Exxon looks to be a cheap Dow stock that long-term orientated investors can consider scooping up. So if you're in that type of market or that way inclined, it might be something that you can have a closer look at, do some more research on, and might be worth a buy. So these backs can be broadly true for other majors as well, such as Chevron. So I think Chevron has low debt levels, low production costs, and high profit margins of the majors. Also have a look at French major Total. That one's definitely one worth a bit further of a look at. Infrastructure wise, have a look at Canadian pipeline giant TC Energy. Gas station operator Casey General Stores. That one's listed in the States. Okay, so let's have a look at a few points here that might be a catalyst to actually buy some of these majors. So the energy industry is potentially on the verge of a long needed restructure. Shale producers are already seeing sharply higher costs of capital in the COVID-19 crisis. Could see that capital disappear completely. Domination of the global energy markets by the big boys if widespread bankruptcies of junior players occur. The big boys have historically shown a high correlation to the price of oil futures, so there's probably a few things going in the way towards the energy majors at the moment. Just waiting to see if pretty much these level of bankruptcies actually do play out. If that all starts to come to fruition, then definitely might be worth having a close look at some of these bigger companies. Okay, so what does the Aussie oil market look like? Are there any opportunities here? So the big players in Australia are Woodside, Santos, Oil Search, Origin Energy and Beach Petroleum. Typically they have lower quality tier 2, tier 3 assets. Pretty much just the cost production is quite high and they just don't have flexibility in their production. Australian oil companies have cash back-even points of around $30 per barrel. Most of the businesses are struggling to break even at this point in time. Woodside is the exception with the estimated cash break-even of between $15 and $20 per barrel. So, I mean, if you're looking for an investment, quite possibly that's the place to look. If you can't actually make any money out of your product, there's probably not much point investing in that company. If you're interested in the Australian market, that's probably the way to go with that one. So your options for using ETFs to place a trade, you're looking at BShares Global Energy Companies ETF. That one gives you exposure to the 50 largest energy companies, excluding Australia. Same with that one, you'll get access not just to producers, but also to infrastructure companies like pipelines and things like that. Performance hasn't been great, so you're looking at a 6.5% loss since 2016. BShares Crude Oil Index, that one's currency hedged and synthetic. That provides investors with a simple way to take a view on oil prices via crude oil futures. That one's had interesting time over the last few months. So your performance on that one's pretty atrocious. So if you bought it at the inception, you're down 29% or thereabouts. So pretty much if you're looking at triple O as the investment, it's really just a short-term investment. You're looking at a day, 2, 3, 5 day type trade, whereas if you're looking at fuel as an investment, that's more of a long-term opportunity. So yeah, a bit of a different play there for those two. So long-term opportunity, bringing the upswing in the oil price with a group of large energy companies, or you can play the short-term type, trade in, trade out, play the futures type of thing, try to make a few grand here and there. Okay, so some people might be interested in tankers, so let's take a quick look at global tanker operations and how the metrics might actually support an investment in some of the tanker companies. Break even to operate, the average very large crude carriers is $28,000 a day. The average 6-month storage contract is 80 grand per day. It is profitable for companies and traders to lease vessels to store oil and sell it in the future date. A quarter of a global VLC fleet are already floating storage tanks. The longer the oil futures curve remains in steep contango, the more tankers will be employed for storage, placing a floor on the tanker spot rates. According to one research note, at current daily charter rates of around $200,000 to transport oil, a VLCC could earn $70 million a year. Potential for some tanker owners to make 350% returns annually, so that's a nice profit there. Despite this, most tanker operators trade at about half their net asset value. That was in one of the research notes I read anyway, so you're probably going to need to do some more research on that, but I think there's quite possibly still some upside in this space. So let's have a look at some of the companies. Should we buy the global listed tanker operators? Let's have a quick look at the biggest ones. So in no particular order, TK Corp is a provider of crude oil and gas transportation, floating storage and long distance towing. It has around 200 larger tanker assets, making it one of the largest crude oil companies in the world. Pays a quarterly dividend of about 25%, which is pretty outrageous. Who knows what that dividend is going to do, but it's definitely something to take note of anyway. Frontline provides seaborne shipping for oil, crude and products, and operates 22 vessels including 14 enormous crude carriers. Pays dividends currently about 6.6%. Tsakos Energy Navigation, however you say that, it's a global provider of seaborne crude oil and petroleum transportation services. It has a large fleet of 50 vessels, with the majority comprising the mid-sized carriers. Pays a quarterly dividend with a yield of about 3.41% when I checked it. This one, Nordic American Tankers, is one that kind of gets a lot of focus, I suppose, from the media and other different commentators around the place. That one specialises in acquisition and chartering of double hull tankers. Nordic American Tankers owns and operates 24 Suezmax crude oil tankers. The dividend yield was about 10.61% when I looked at it last. Ship Finance International Limited is a business that owns, operates and charters vessels. Its fleet includes around 60 different sized large vessels. Pays a quarterly dividend of about 11.85%. DHT Holdings owns and operates crude oil tankers and has a fleet of 18 crude tankers, including 14 VLCCs, with the recent market cap of 742 million. Its 2014 revenue stood at around 150 million. trailing 12 months earning per share of $1.03. It pays a dividend quarterly, and you'll get a dividend yield of about 9.29%. So these are just some of the bigger companies. If you're interested in this play, you definitely want to go back and actually have a look at some of these companies and in greater depth. So we definitely need to be careful when we're looking at and trying to value these companies. To actually value the crude tanker companies, it's actually quite complex. So you're looking at factors like oil prices, demand, supply, route of transportation, which I'd never actually contemplated before, but obviously the way you go impacts the cost, and geopolitical developments. So, you know, politics and people playing games with oil and transportation of oil products, petroleum products. So what's the rub? What's the game plan? Oil prices have been soaring after hitting unimaginable lows a few months ago. Energy remains a sector that's critical to any eventual recovery in global growth. As recovery continues, the quality energy companies will rise with the tide as well. Even if you didn't buy oil stocks at the depths of the crisis, there is still a good chance to ride the upward wave as the global economy reopens. Definitely as more people are driving, getting out and about, you're going to see a rise in the requirement for fuel. Another bit of an interesting tidbit is the Saudi Arabians have been buying up quite a bit in the last 2 or 3 months, taking advantage of the price dip. So the Public Investment Fund, PIF is the acronym, so they bought $828 million of BP stock. They spent $481 million on Suncor Energy. They've also spent $482 million on Royal Dutch Shell. They've dropped another $480 million for the Canadian Natural Resources company, and they've also spent $222 million on Total SA. So if they're dropping that kind of money, I think there's still opportunities in the market, so they see long-term value. Obviously they're trying to diversify away from Saudi Arabia and reliance on just that one income stream. But you know, if you actually go back and have a look at BP, Suncor Energy, Total, Royal Dutch Shell and Canadian Natural Resources, they might be another group to actually have a look at. Just out of interest, so Suncor Energy, Berkshire Hathaway sold all their holding in Suncor Energy, and the Saudi Arabians are buying Suncor Energy. So that tells you that there's the differing views on energy into the future, oil and gas and fossil fuel energy sector. Anyway, I hope hopefully that was helpful. Definitely some opportunities to be had there. Definitely a lot of different options to take advantage of it. A little bit of information to sift through. Let me know what you think. Thanks a lot, guys. Ciao. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.